Financial markets, liquidity is a key concept for the markets. From investors' perspective, it means that when you hold an asset, you will easily find a way to transform this asset into cash or into another asset. So it can be an equity, it can be a bond, into another asset or into cash in a reasonable time frame and without a major impact on the price. So it means that there is an easy way where the seller and the buyer can find themselves. Markets need liquidity, that's a given, but if they are over-reliant on liquidity, then they dysfunction. And there are two problems we can highlight there. The first problem is that they tend to have a herding behavior, meaning that they will all go in the same direction very quickly, and with this dramatic impact it has on the stability, meaning everybody selling at the same time, everybody buying at the same time. That's the first problem. The second problem is that an over-reliance on liquidity as a criteria for investment decision distracts investors from their duty when they invest, analyzing the risks, the return, the very nature of the asset before investing in it. For sure, we are observing today that there is a decrease in liquidity in some markets, like some parts of the bond markets, based on a number of indicators that are traditionally used. But the issue is how bad this is for the economy and society. For sure, less liquid markets mean less revenues, less profit made out of trading activities. So this can be an issue for some parts of the economy, for some players. But the question is that really the core issue, taking it from a regulatory or a societal perspective? So from a society's point of view, there is such thing as too much liquidity. And the head of the asset management arm of JP Morgan says it quite well. He said reducing liquidity could force people in the market to be investors again, rather than just traders. In fact, the citizens should be concerned about a financial system that is over-reliant on liquidity. Because as said before, not only does it lead to wrong investment decisions, less productive investments, but also it creates more dangers for the system. It makes crises more violent when they occur. And as said by Keynes at the time, the fetish of liquidity, as he called it, is antisocial. This can be debated, this formulation can be debated, but what's for sure is that the doctrine of liquidity distracts investors from what they are supposed to do, to take decision for long-term investment for the good of the economy and society at large. So if we sum it up, the message is markets need liquidity, but they should not be over-reliant on liquidity, because then it comes at a cost for the economy and for society at large.